So welcome to my next presentation. Today we're going to be speaking about Chapter 7, Paying for College. This is right out of my book, Financial Independence, Getting to Point X. Please take a moment and read the famous quote at the bottom of this chapter, which is right on the screen there. Okay, in this chapter we start off with this question. Do you have sufficient funds set aside to pay for your children's or grandchildren to attend college? If the answer to that is no, well, guess what? You want to focus on this chapter. So there are so many exciting and interesting ways to save for college. Number one is using a 529 educational savings program. Another strategy is using Uniform Gifts to Minors Act. That is definitely not my favorite, and I'll tell you why a little later. Utilizing college educational savings accounts. Those are called Coverdale accounts. And also utilizing U.S. savings bonds as another means of saving towards college. So I'm going to talk to you about some of these in just a moment. So what I have up on the screen here is the difference between using a 529 plan in helping you achieve that goal to save for your child's education, and if you don't use a 529 plan. So what exactly is a 529 plan? 529 stands for a code section of the IRS. It's called Code Section 529. The federal government came out with this rule. If you put money aside in a special account titled 529, any income you earn in that account, regardless of how it's invested, will be tax-free income. Over the course of 17 or 18 years or even longer that you're saving this way, it will make a dramatic difference in the amount of money your child will have set aside for college. Now, in the example we have here, we're assuming you're putting away $10,000 a year in the first day of each year for the first 18 years, and we're assuming that you're able to earn an 8% return compounded from day one through the day that you need the funds. And at the end of the day here, we're also assuming that there's an effective tax rate of 40% that you'd be paying. So the net difference between the two is as follows. By utilizing a 529 plan during this 18-year period, you're going to accumulate $374,500, and that's what will be available for your child's education. If you didn't take advantage of a 529 plan, but invested the money exactly the same way, but not through a 529 plan, you would only have $276,000. That is a significant difference. That could easily pay for one full year, maybe even 2 full years or more of college for your child just by making the difference of using a 529 plan. In addition to that, these are the federal rules that also apply at the state level, but many states offer special tax advantages. Every state's a little different, but let's use New York as an example because that's where I'm sitting right now as I speak to you. So in New York, you're allowed to put away up to $10,000 per year as a married couple to a 529 plan. Now, what does that mean? You set aside that $10,000 before the end of each calendar year, put it into a New York State approved, by the way, the 529 plan for New York State is the one you would have to use if you're a New York State resident. You put that money in that plan. That $10,000 you contributed is now a $10,000 tax deduction available to you on your state return. If you're living in New York City and paying 12% or more in state and city income tax, that $10,000 contribution will save you an additional $1,200. That savings would be every year that you contribute that $10,000. The way I like to look at that, it's like getting a $1,200 New York State scholarship for your child. Even while they're in diapers, you're getting that $1,200 up front in the form of a New York State tax savings. So definitely take advantage of 529 plan. The example I gave you, it's the only place in the tax law that I know you get a tax break up front at the state level, and then you get tax-free income when you pull the money out to pay for college. Very, very powerful tool. If you're not taking advantage of it, you really need to think about it. Now, another big area is once your children are in college, what tax credits are available to you. So again, a tax credit is a dollar for dollar savings in the amount of taxes you pay. These are very, very powerful tax breaks. So there's the American Opportunity Tax Credit that I have up on the screen. If you're a single individual filing on your own, if your income is below $80,000, you could qualify for up to $2,500 tax credit. If you're a married couple and your income is under 160, you could get the same amount of a tax credit. Now, the key to remember here is in order to qualify for this, you have to pay tuition out of pocket. The first $2,000 that you pay in tuition, you get 100% tax credit. The next $2,000, you get a 25% tax credit. The maximum would be $2,500 per year. That is tremendous. So let's assume you sent your children to a state or city school. Let's assume the tuition is about $4,000. As long as you're paying at least $4,000 out of your own pocket, and that could also mean you borrowed the money somewhere, that's perfectly fine. You'll qualify for this $2,500 tax credit. Very, very powerful. In addition to that credit, once you're in college, chances are you're going to be using the original credit I was talking about. You're going to be using that during the first 4 years. But if you have children that are in graduate school, or even yourself if you're in graduate school, then you want to look at what's called the lifetime learning credit. This credit is available for an unlimited number of years. So it doesn't just apply towards the first 4 years, because you could use it for that, but the other credit I mentioned would be more ideal. But if you're in college for the next 20 years, even if you're just taking other courses, you're going to qualify for this tax credit as well. The threshold has recently been matched up with the other credit. It's also $80,000 and $160,000. And the way this credit works is you get a 20% tax credit as long as you're within that income limit. And the first $10,000 you pay times 20% gives you that $2,000 tax credit. Also, I forgot to mention before, if your income is within those income brackets, again, for married between 160 and 180, that credit gets phased out. The bad news is if your income is over 180 as a married couple, you don't get a penny of that credit. It simply doesn't apply to you. So that is definitely something, if you qualify, you definitely want to take advantage of. So the action plan in this area is going to include, number one, decide if college is the right choice for you or your child. Find out today what your college cost is going to be when that child is ready to go to college, and start saving for it. You have to go through and do a family needs analysis. I cover that in great depth in my book to see what type of college your child could afford to go to. The next thing you want to do is understand the differences between the various programs that are available to you in terms of saving for college. We covered some of them here today. Keep in mind that the most important thing about 529 plans is that you, as the parent, get to keep control of that money. Even though that money is being set aside into a 529 plan on behalf of your child, you are the one that is technically the owner. They are the beneficiary. The reason that's important is you could change the beneficiary at any time. If your child decides not to go to college, then you could use that money for your other child who is going to college. So you still retain control over that money. And lastly, you want to also consider having your son or daughter work a part-time job. Teach them the responsibility of working at an early age. Let them put some money aside every single year. But part of that savings program for your child, they may be able to put money into a Coverdale educational savings account or even a Roth IRA account. And many of you are probably saying, why would I be thinking about a Roth retirement account for my child? Well, the truth is you could also utilize a Roth IRA account as a college savings vehicle, because when the time comes, your child could pull money out of that Roth IRA account. Whatever money they put in comes out tax-free. Any income they earn, they pay tax at their lower tax rate. But the 10% penalty that normally would apply when you take money out of an IRA before the age of 59 and a half will not apply, because that's one of the exceptions to the 10% penalty. So sometimes we have to think outside of the box, but I would encourage you, Have your children work, teach them the responsibility of a dollar, and use every retirement savings vehicle available to you so when the time comes, neither you nor your child will have to be in extreme debt.